Hello everyone, welcome back to my channel. Happy Diwali to all of you in advance. And today I am going to share with you one very important topic in accounts, that is ratio analysis. And I am going to discuss only 5 key ratio analysis in accounts, right? So as you know, what is ratio analysis? Actually, ratio analysis indicates a business, an organization, financial position, and how an organization is performing and how an organization is going to perform in the future. So this is all about the ratio analysis. So our first ratio is current ratio, right? So current ratio is the ratio by which it is actually shows the company's ability to pay off its short-term liabilities, right? So when I'm talking about the ability to pay, so a company must have some short-term assets as also to pay off this. Now these short-term liabilities and these short-term assets are called current assets and current liabilities, right? So if I talk about the ratio, the formula of current ratio is current assets by current liabilities. You can see that it is calculated by dividing current assets by current liabilities, right? So I'm taking an example, and the example is my current assets worth 5 lakh dollars and my liabilities is $250,000. So my current ratio will be 5 lakh by 2,50,000, and that comes to your 2 is your ratio, right? Current ratio. Now, from where I can get this current assets and current liabilities? If you can remember your balance sheet, you can easily identify what is the current assets and current liabilities of an organization, of a company, right? Now our next is debt equity ratio, right? So this ratio indicates the proportion of debt to equity, right? So what is your debt and what is your equity? That you have to ascertain first, and you can easily calculate the ratio from there. And what is the formula to calculate this debt equity ratio? That is total debt. It is calculated dividing total debt by shareholders equity. How much debt you have or a company has in the market divided by shareholders equity. So I am taking an example that I have a total debt, or the company has a total debt in the market $2 million, and its shareholders equity is $5 million. So my debt to equity ratio will be 2 million by 5 million. That is your total debts in the market, that is 2 million, and shareholders equity, that is $5 million, right? So my ratio will be 0.4. Now the next very important one, return on investment. Why an investor would invest money into the business or into a company when he will get the return from it, right? So a return of investment is a very important ratio analysis, because a company's reputation, a company's financial health, it all depends upon this ratio. Now what is the formula to calculate the return on investment, right? So it is calculated dividing net profit by initial investment. When the business started, what was the capital? That is initial investment, and net profit, as you can get it from your profit and loss statement, right? And then multiplying by 100 to get a percentage. So I'm taking an example. An investment generates a net profit of $10,000. Okay, and the initial investment was 1 lakh. So obviously, $10,000 divided by 1 lakh dollar multiplied by 100, and that will be your rate of a return on investment, and that is 10%. Okay, so I hope so far so good. You have understood everything. And the next one, gross profit margin. The gross profit margin ratio is just to divide gross profit by revenue multiplied by 100 to get the percentage. So gross profit, you can easily get it from your trading account, and net sales, you can also get it from your trading account. So you have to identify what is my gross profit and what is my net sales. Then I can easily get the gross profit margin ratio. Here I am taking an example that my gross profit is 5 lakh dollar and I have a sales $1 million. So obviously 5 lakh 1 million equals to, as you know, 10 lakh dollar. So divided by 10 lakh into 100, that comes to your 50% is your gross profit margin ratio. Next one, return on investment. So company invests a lot of money in their assets to generate a revenue, right? Now, how much return company is getting from these assets? That is also a very important part and needs to be very careful while investing on assets. So my formula of return on assets will be total net income by total assets, right? Net income by total assets will be my return on in assets ratio. And obviously, to get the percentage, you have to multiply by 100. So, suppose if a company has net income of 1 lakh dollar and it has assets of $1 million, so return on assets ratio will be 1 lakh divided by 1 million, that is 10 lakh, into 100, that comes to 10%. So these 5 key ratio analysis is very important in accounts, and I hope you understand everything and how to calculate this one. My request to all viewers, those who are new, please subscribe my channel, hit the bell icon for my upcoming videos, and those who have already subscribed, please watch my video till the end. Thank you very much for watching my videos.